because I always try to raise twice as much capital as I need for any given deal,
Smart.
right? And in this case, I think we only needed like 750,000. We ended up raising like over 3 million from that call. The deal was fully funded the night of the webinar.
There are millions of real estate investors out there, and most are stuck with just a couple of properties. They want financial freedom, but their small portfolio ends up costing them more in time, effort, and money than it's worth. Getting out of the rat race seems harder than ever. This show will help you do more deals, better deals, and bigger deals. Finally, you'll be able to reach your income and lifestyle goals. How? By attracting and leveraging private money partners and their capital. Now get ready to raise more money, because here's your host, Dave Dubeau.
Well, hey, everyone. Dave Dubeau back at you with another episode of the How to Raise Capital 101 show. And today, zooming in from so far away. Actually, that's a joke because Cory's, in our neck of the woods, just kind of a stone's throw away. He's in the next big town over in Kelowna, British Columbia. I'm here in beautiful Kamloops, British Columbia. And Cory is a very interesting real estate investor. He focuses on multifamily properties, but even though he's lives in British Columbia, he does all of his deals in the prairie provinces of Canada, primarily in Alberta. Do you have a few in Saskatchewan as well, Cory? I can't remember.
I do. Yeah.
Yep. All right. So Alberta and Saskatchewan. He's been doing this for quite some time, I believe over 20 years. He's got a bunch of deals under his belt. And today we're going to be talking about kind of making the transition from joint ventures into limited partnerships. So Cory, great to have you on the show again. Welcome back, my friend.
Thank you for hosting me, Dave. And it's a little bit more than a stone's throw away, but I always look forward to going to Kamloops, and we'll have to get you down here one of these days too.
Well, hey, man. Yeah, we had you up here for our local real estate investment club meeting not that long ago. It was a big success, talking about the different profit centers in multifamily investing. And in fact, Cory's come up with a new one that the rest of us hadn't heard of before. So that was very, very enticing. But today, let's talk about the whole raising capital side of things. So Cory, for folks that don't know your story, can you tell us a little bit about how you got started with raising capital and what that looked like in the early days for you?
Yeah, for sure, Dave. In the early days, I was kind of, like many investors, just doing small deals. I was doing single family. I bought a couple of duplexes, with family members. Like my brother was my first partner. But I never actually raised passive capital from someone who was not actively involved in the deal.
Okay.
So around 2004, I syndicated in someone else's deal. So it was a guy in Edmonton, Thomas Byer. He was doing a multifamily. It's like a 40-plex, and I just became a silent partner. And that's how I first learned how joint ventures, these kind of deals worked. And it was fairly simple. It was just one corporation. I think there was 5 investors. And it was just a super hot time in the market, right? In Alberta from 2003 to 2007. So you kind of couldn't go wrong. So I ended up being in the right place at the right time. But I did a couple multifamily deals on my own first. I was living in Saskatoon at the time, around 2005. So I moved to Edmonton in 2005 as well.
Mm-hmm.
So first 2 apartment buildings I bought in 2008 and 2010. One was in small town Saskatchewan and one was in Edmonton. So I funded both those deals, with my own capital, because I was always told, you should have a track record first. You should, from start to finish, do it successfully and then repeatably, and then you can ask for JVs. And I see a lot of people syndicating right out of the gate or raising capital. I don't see anything necessarily wrong with that. I mean, it wasn't the path that I followed, but
well, it makes it a hell of a lot more
line.
difficult to show a track record if you don't have one, right? I mean, that's the big challenge. So yeah, I see so many people, like you say, wanting to raise capital for their very first deal because they don't have any money. And I don't know what your recommendations are, but my recommendation is always, hey, go put some sweat equity into somebody else's deal, get that track record, get that experience, get that team in place, and then maybe start raising capital for your own deals. What are your thoughts? I mean, it sounds like that's you didn't go that route exactly, but you got the track record first.
Yeah, I know. I like the way you worded that, getting sweat equity in someone else's deal. But yeah, absolutely. I mean, the conventional path is, you get a job, you borrow money, you get a house, get home equity, put your own skin on the line first before you expose someone else's.
Yeah.
Or you can just JV in someone else's deal too. And that's a
Yeah,
great way
like
to
you
learn
did
the
in that,
ropes.
like you did in that 40plex, right? You went on board
Yeah,
as a limited, well, I guess a joint venture partner in that deal,
joint venture partner.
but
Yeah.
more on the passive side, or were you actively involved in that deal?
I was very fortunate because the guy I partnered with, Thomas, he was very open.
Hmm,
He literally shared everything and he kind of took me under his wing, you
nice.
know, and I learned a lot about, the process, how you do proper reporting. He was really good on sending out reports, being very, transparent with his investors. Although we had just nothing but rising markets, we didn't have to deal with any kind of downturn. So we didn't have any awkward conversations that I would end up having later with my own investors. But
Yeah.
if you're in the game long enough, as you know, Dave, you go through cycles, right? And
Yeah.
eventually you run into these situations where it's not always a straight line.
Yeah. Well,
But
we'll
unfortunately,
talk
yeah,
about that as we go
yeah,
along for sure. But yeah. Okay. So it sounds, so you got started self-financing, you JV'd in somebody else's deal. What was that first deal that you raised capital for yourself, brought on your own joint venture partners? And how did you go about doing that at that time?
yeah. So at the time, there was a guy in Edmonton. He was a really famous investor called, his name's Terry Peranich. He's a really well-known realtor, but he also owns a lot of multifamily.
Mhm.
And I went to this multifamily conference in 2010 where he was speaking, and he was a big public speaker. He likes to use his hands a lot, and he's saying, you got to go driving for dollars. He's like, you got to go cruise in neighborhoods and find buildings. He says, just get them under contract, worry about raising capital later. If you find a good deal, the money's going to find you. And
Ooh.
I thought, that sounds good, but it can't be this easy.
Mhm.
So I decided I was going to kind of take a hybrid approach. I wanted to start the ball rolling and call those conversations first before I found a deal.
Okay,
So I
good.
did that. And if I had not have done that, I would not have been able to meet the needs of the capital in the short timelines, right? So I talked to a couple coworkers, but it was mostly my family. Like my brother went in, my parents. But even to get your own family in, you need to have the conversations early. You can't just assume that they're gonna give you money because they love you.
Yeah.
They have to be
Yeah.
on
You
board.
can't assume, as I learned the hard way, that somebody's going to come up with $100,000 to close on a deal with you in 2 weeks, right? You need to plant those seeds way ahead of time. Let me ask you this,
Exactly.
Cory, because we've got the same philosophy when it comes to the money of the deal. Ideally, the money should come first, or at least get those investor conversations, get those soft commitments lined up first.
Yeah.
This other gentleman that you're talking about, he said, like so many gurus do, find a good deal, the money finds you. But you said something that I found interesting. And here's my take on that. That's easy for a guru to say, right? Because they're already well connected. They've already got this extensive network of people who already see them as the expert, see them as the go-to person, see them as the deal maker, the rainmaker, the profit maker. And so for them to find the deal and then put the word out to their network, yes, that can work. However, as you alluded to, when you're first getting started, you don't have that, well, you had a bit of a track record already, but you don't have that network set up like these gurus do. So that's what ticks me off so much about the find a good deal and the money will find you, because all the guys that tell us to do that have an amazing network primed and ready to go already. They've already planted those seeds way ahead of time. What are your thoughts on that?
Yeah, you nailed it. I mean, I've been helping people with multifamily too, and I basically say the same thing. You're starting from scratch, raising capital, and the guru is like you say, and ultimately the people, they're not investing in those deals. Like
Yeah.
they could really care less about what's under the hood. They're investing with that person
Mhm.
for that person, hopefully for that person's track record, and not for a Grant Cardone style rants they do online or something, right? There actually some substance behind that. But they're primarily investing with the person. So
Right.
I'm finding that now when I'm raising capital today, is people are investing, they're investing in me because they know who I am now and stuff, and they
They
didn't
know you,
before.
they
So
like you, and they trust you, right? And the deal is the collateral for the investment. That's what somebody way smarter than me said, right?
Yeah.
Like you said, it's not the deal itself, it's the relationship they have with you.
Yeah. So right now, today, I could go out like we just did on this deal in Fort Saskatchewan. Even though I haven't talked to some of my investors in 2 years, because I've put 20 years into this, I could find a great deal tomorrow and call these guys up and probably raise the capital in a week.
Yeah.
But if I'm
Exactly.
just starting, if I'm guiding someone on how to do this, it's a suicidal approach, right? Like,
That some of us crashed and burned on in the
yeah,
past. That's for sure. All right. So, okay. So you got started, you're doing joint ventures. If I'm not mistaken, you've done like close to a dozen of them at this point. So why are you looking at, well, first of all, why don't you kind of explain what a typical multifamily joint venture deal looks like, from like maybe pull one of your deals, your more recent deals, not the ones you're working on right now, but from a couple of years back. How does that structure look like, Cory?
yeah, I had a very good structure, and a lot has changed, but I'll go through the structure that I used for probably 6 deals in a row. It was
Okay.
pretty much exactly the same. I never used CMHC financing. I always used conventional financing because my partners didn't have to sign personal guarantees. So I could sign the guarantee alone, and I would generally raise. So on one deal, for example, it was a 15 plex. I think it was around 1.4 million. I raised about 500 grand between four
Hmm.
investors. So
Okay.
giving us a nice healthy reserve of about 5% of the purchase price. So it was 25% down mortgage, 25-year amortization. So after 5 years, I knew we were going to have a nice mortgage paid down in the event that the cash flow and the equity weren't there,
Hmm.
which is largely true today in a lot of these deals, especially with the high leverage options we have now.
Mhm.
So that model worked very well. And from
So
2008 to 15, interest rates were stable. So I could do conventional financing, 3.5% interest all day long. I could just
And
keep
how
doing
were you
deals.
setting these up? What was the structure that you had everything set up under?
So I had one holding company that was like my wife and I. So we had Alton Equities. So we would do a single company for each building.
Mhm.
So the way we did the split is we got 40% of the equity, the investors got 60%. They would contribute all the capital in the form of a shareholder advance that we would repay, and that would be of just a return of share capital. Then anything over and above that was split 60-40. Usually when there was a capital event. So when there's a refinance, or in our case, we would sell the building. So we had a kind of a projection going in of what we thought we could do in 5 years. And for the first few deals, we hit those targets bang on. And that was a model that worked very well for many years.
All right. So you had a holding company. Your holding company would be a partner in this, a general partner in this new corporation that was purchasing a specific property. Your investors would come on as co-owners, as shareholders in this
Yeah.
corporation. They'd provide all of the capital plus some cushion for the deals. And
Yeah.
then, yeah, well, we won't get into the details on how that was divvied up and all that kind of stuff. Okay, very good. So that makes sense. Up till about what size or a number of partners does that work for? And and I won't hold you to this, Cory. You're not a securities lawyer or anything like that, but what are the kind of what's your understanding of the rules and regulations around who you can get on board with these kind of joint venture deals?
Yeah, this is part of what's changed a lot. And there are exemptions, family, friends, close business associates. The biggest one is probably the accredited investor. In BC, we have one. If it's, if you have 150,000 to put in, you're considered accredited. Not necessarily by default, but there's 150,000 exemption. So I was pretty diligent to get those done, or get people to sign off that they were
Mhm.
doing. Almost all of the deals were with close people that I knew. Now,
Right.
it could be challenged if something ever went south on a deal. Knock on wood, I haven't gone there yet, but that's definitely something you need to be aware of when you set up these deals, for sure.
No, it usually isn't a problem unless the shit hits the shit
Yeah.
hits the fan kind of thing, right? Yeah, no, makes sense. Okay, so that's what you did for the longest time. What you said you did that for a certain period of time. When did it start changing, and what did it start changing into?
Yeah, so I think I did the last one of those type of deals around 2017. So there was a stretch where I did about 6 deals in a row. But I was finding I was raising anywhere from 500,000 to about 1 million. I think
Mhm.
900 was the most. But in some of those deals, they had like 8 investors. And then when they had their spouses on there, there's like 10 people that signed one unanimous shareholders agreement, which is the share agreement, right? So it gets pretty hairy when you have that many investors. So
So
part of
sorry,
what I've been,
what's
yeah.
the challenge with, what was the challenges that you were finding with that?
Well, it was good that I didn't have to get anybody to sign guarantees because I was going conventional financing. But you still had to get this document, this unanimous shareholders agreement document signed by 8 sets of people, after they ran it past their lawyer.
Independent legal advice, all that kind of stuff. So their lawyers
Yeah.
have to chew it up for a while and justify their fees and tweak it and all that kind of stuff. So it's herding cats is basically kind of what I'm hearing. Is that long and the short
Yeah,
of
but I
it?
was pretty. So what changed with the latest one, because I did the same structure there. What was happening before is the investors I had, I wouldn't say they're not sophisticated, but they're not real estate experts. So
Right.
I did up a USA that was fair for all parties. I did that intentionally. So if they did have it looked at by independent, I could push back and say, this is not lopsided in my favor. This has worked
Mhm.
out fairly. And a lot of people they did get independent advice. I got them to sign off on a paper that they were going to do that, whether they did it or not.
Right.
Um, but I never was challenged on it. Everybody
Okay.
just signed the original draft. But the deal I just tried to do was a different story because we had sophisticated investors in this latest deal. In fact, we had one partner who I didn't know at the time is actually more sophisticated and experienced than me. So I got a bit of schooling myself, which was actually a very rewarding experience. But it's also kind of really painted the picture on the path forward of going the road of syndication, limited partnership versus those single corporation joint venture deals, right?
Okay. So what kind of came to light through this new experience? What was it that kind of made you decide, okay, hey, I gotta start looking at a different structure?
Well, the biggest thing was the guarantees, Dave, because now because because CMHC MLI Select essentially wiped out business for every commercial mortgage broker in Canada who was doing conventional. You can still get conventional financing, but with interest rates today, you're probably looking at 6.5%. You can still
Mhm.
do CMHC for 4%. And then with this MLI Select now affordable program, especially on the prairies, every single investor seems to be dialed into this program because you can borrow at super high leverage, 95% loan to value, 50-year amortization. This is the sandbox that as investors, we're almost forced to go in. Now, we did a private loan for this latest deal, but one of the investors I didn't know. So I wasn't raising capital publicly. We had a webinar where
Mhm.
I invited people on my email list. Now, I had a lot of people following me over the years, as you probably do too, right? People follow you, but you never talk to them. You don't know who they are until they contact you.
Right.
So this lady said, "Yeah, I'm interested," and she was in for 250,000. I thought, great. And then we got to talking, and I realized, like, okay, she owns 3 times as many apartment buildings as I do. She's done limited partnerships. She's done full syndications. She's telling me about all the pros and cons, and I'm thinking, holy shite, what have I got myself into? But she recognizes a good deal. She wanted in on the deal. She was comfortable with the structure. But when it came time to do the USA, instead of me just doing my
Oh,
version
so
and
for people that aren't familiar, what's a USA?
yeah, oh yeah, I kind of so unanimous shareholders agreement
Okay.
in a simple corporation, right? It costs like $1,000 to make this company,
Mhm.
but the unanimous shareholders agreement is the joint venture agreement. So that is the agreement that spells out all the terms. Who owns the shares. Under what stipulations can you sell the shares. What happens if someone dies. All your contingencies are in there.
Got it.
So when I came to doing the USA with this very sophisticated investor, we realized that our USA was not up to like 2023 standards, I'll say. So there was some horse trading back and forth.
Yeah.
And to make it more complicated, we had a veterinarian who funded the entire deal on a private mortgage where he had his own lawyer and his own interpretation of the USA.
Oh,
So
wow.
we're up against that tight timeline here, trying to get, I don't want to say herding cats, but that's almost what it was like.
Yeah.
because now I'm looking at it, well, whereas maybe I'm not necessarily the strongest person in my own deal. And I have to be extremely careful on this USA that I'm not shortchanging myself.
Right.
So it put a whole new dynamic on the whole thing.
Okay. So it sounds like a little bit of a unicorn in this particular deal. This lady who's got so much experience being one of your partners, right? With that you didn't really know ahead of time. She knew you. She's been following
Yeah.
you for years. I always find that amusing, though. It's true, though. You can have people that are. I mean, you're the real deal. You're legit. You've been doing this for 20 years. You know your stuff. But you can have some posers out there that are projecting that they've got a lot more experience than they actually have, that attract people that are way more experienced than them, that for some reason kind of look up to them. It's fascinating how that happens sometimes. But anyhow, so you've kind of had this unicorn experience. Why is that going to cause you to change your whole model of business?
Well, it didn't so much for that deal, but it's just the sheer volume of response we got from this webinar. So
Okay.
so what I did is I have a non-binding letter of intent, because I always try to raise twice as much capital as I need for any given deal.
Smart.
Right. And in this case, I think we only needed like 750,000. We ended up raising like over 3 million from that call. The deal was fully funded the night of the webinar.
Nice.
And I was like, okay, I said to my partner, Mike, I said, well, what do we do here now? We got like, all these people that want in on
we
a deal.
we
don't
better
have a
find
deal.
some deals. Yeah.
Yeah. But, at the same time, we've seen a lot of these LPs where people will raise the money, charge massive fees, etc., and don't have anything on any deal there. So it's basically a leap of faith to what they're going to buy.
Right.
So we wanted to be very careful to at least have a deal that made sense. We didn't want to raise a bunch of capital and just having it sit in there and be highly pressured to go out and buy something, anything.
Mhm.
So that's the trick, the juggle that we're doing right now, right? Because we want to have the sort of the quasi commitment of the letters of intent ready to pull the trigger when we find a deal. But that's the main switch, because with a simple corporation, it's pretty easy. You just do it. Well, not easy per se, but you know what I mean, right?
Yeah. Yeah. Okay. So what do you see yourself doing moving ahead? What are you going to be changing?
So a lot of these deals, they're still rich enough to still do on the old format. So now I have a bulletproof USA that has actually been torture tested by an extremely sophisticated investor. We have all these indemnifications in there, piggyback clauses, shotgun clauses, everything in there that protects both parties. So for example, we have a 12-suiter under contract. Now, we maybe only need 300 grand for that. Now, is that worth spending 30,000 to do an LP?
Probably not.
Probably not,
No.
but if I have another deal that's, a 50-unit apartment building where I need 2.5 million. Well, now, yes, that makes sense. I can justify the cost of that LP and getting it all set up, maybe even having an exempt market dealer offering them sales commissions, etc., to do that. But then it's a completely different structure. So I think we're taking it on a deal by deal basis. If we have these smaller deals that we can close with one person, because keep in mind, we still have to get the partners to sign a guarantee.
Right.
And that's a big deal, a big deal. Like I've never had a guarantee called, and thankfully, and hopefully I don't, but it happens. It can happen. So
yeah, that changes things tremendously. That's for sure.
Yeah.
Okay. So Cory, you're at a stage now. You've been doing this for over 20 years. You've got followers for all sorts of things that you've been up to, and teaching and training and mentoring and putting on events and all that kind of stuff. What kind of advice do you have for folks that are nowhere near that stage, but are looking to start raising capital? What are your recommendations for people?
Well, I always say, do a deal first with your own capital. But if you can't do that, it's a stretch. I know a lot of people don't have 500 grand to start with. Partner up with 2 or 3 or 4 other people that are maybe you have opposing skill sets, and do an equity deal like that, so that you have 100% proportional equity going in, and that will help to build a track record. And I think you said at the beginning, I mean, not having money is a terrible reason to do a JV, right? Like, and especially it's so tough today because everywhere you look, people are trying to raise capital. publicly, right?
man.
On all kinds of social platforms. And it's like shocking to see that. But
Yeah.
I'd say just do your best to do a track record. Start with a track record. Hold yourself to account, a high level of integrity, and just build slow.
Yeah.
I know people now that I started working with a year ago, and one guy, he's at Sam, he's already doing an LP. He's beat me to the punch just because he's got a system and process. And now I actually reached out to him for advice. He says, yeah, if you have any more than 5 investors, or if it's more than 2 million, then you should do an LP. But you could ask 10 people that question and get 10 different answers.
Right.
When to go from LP to a single corporation. Now, going to an LP, it might take the personal guarantees off of the shareholders, but there's other nuances that get added in. Right?
And expense.
Exactly. Significant expense.
Yeah, definitely. No, that makes a lot of sense. Awesome, Cory. Well, this has been a lot of fun, and congratulations on getting that done. Sounds like that lady was a real pain in the butt, but in the big picture, like you said, it's a big benefit because you're getting, you said schooled, but you're getting educated, right? Just as you're going up and you're having to bring everything up to that next level. And like you say, now you've got a bulletproof USA for those kind of deals moving ahead. You're good to go for a significant amount of time. And now you've already got this pool of investors biting at the bit to invest in your next deal. So now you've got the comfort to know that should you find a smoking deal, it won't be very tough for you to find the capital to close on that. So
yeah, and there's different investors too. Like our partners, some people have $500,000 to $1 million, right? Some people only target them, but some people, with the LP, then a lot more people can participate.
Exactly.
They can put in the lower amounts. But the lady for the deal there, I'm very grateful. She's actually fantastic to work with. I actually met her just a few days ago.
Nice.
And if I hadn't have met that, this wouldn't have turned out. So it forced me to be a more sophisticated investor. I wouldn't say I was unknowingly incompetent, because incompetence is a bad word, but I was unknowingly, there was things that I could have improved on and didn't realize.
No, that's awesome. For that. She forced you to kind of sharpen the saw a little bit.
Yeah.
No, that's
a good
great.
way to put it.
Awesome, Cory. Well, this has been a lot of fun. If people want to find out more about you and connect with you, what's the number one best place they can go?
Probably just my website, altonequities.com, ALTYN equities.com. Or you can find me on I'm on Facebook and Instagram. You can just follow me there. Usually posting some stuff. So yeah, come and check that out. Come and check out a webinar or something. I'm always doing deals, raising capital, and doing shows like this. I really love what you're doing here, giving back. It's great. It helps a lot of people out.
Well, thank you, my friend. Appreciate it. Always a pleasure. And everybody, thanks for tuning in. We'll see you on the next episode. This episode is brought to you by moneypartnerformula.com. Our Money Partner Formula service allows you to raise all the private capital you need to do all the deals you want while we handle the hard stuff. We offer reliable and affordable done-for-you marketing services that get you investor meetings booked without all the work. So go ahead and check out the website right now, and then feel free to schedule a call with me, and let's take your portfolio to the next level. Again, that's moneypartnerformula.com. Watch investor meetings pop up in your calendar. We handle the rest.